Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. US government bonds are experiencing a significant sell off even as the Federal Reserve cuts interest rates, echoing the 1995 scenario under Alan Greenspan when a soft landing was achieved. Since the Fed reduced rates on September 18, 2 year yields have climbed 34 basis points. Traders are now expecting the Fed to lower rates by 128 basis points through September 2025, which is down from 195 basis points anticipated about a month ago. This shift indicates a belief that the resilient US economy may limit the Fed's ability to cut rates aggressively. Additionally, the rising yields reflect a potential Trump trade, with markets anticipating higher deficits and inflation if there is a Donald Trump victory. Good morning, JK. You have been constantly maintaining yields remaining higher due to multiple factors that are supportive of such situations. Do you anticipate any risks that may arise from such elevated yields in the face of rate cuts?
Hey, good morning, Swaraj. Yes, bonds are for sale in US, and that's been there for last couple of weeks. And you know, as we also hinted, the resilient US economy is one of the reasons we have had no worsening of the jobs data after the July number, which made the Fed revise its outlook, and then inflation has been sticky, about 3%, not really coming off as Fed expressed its confidence. And markets mispricing of rate cut expectations, and somewhat, even the forward guidance from Fed is somewhat being questioned, looking at the way inflation is panning out, and also the the economy that has been performing much better. So all this leading to almost 62 bpa rise in the 10-year yields, which it hit at 4.22%. And also the divergence between US and other economies is also quite stark. There's one thing that the large investors have been looking at, is one of the legendary bond trader Paul Tudor Jones, who said he wouldn't own US treasuries even here, even after 62 BP rise in the tens. He would still be short in the long end. And his particular view is that no one has the political capital to rein in the huge US federal deficit spending. So that's the crux. Inflation and the growth picture are cyclical, but the structural issue is the deficit and also the debt that keeps the yields higher. So I am not sure how far other markets will react to these higher yields. Whether the dollar will keep going up, or at some point the dollar will start losing ground because of the global investors not wanting to own much of US bonds. But that is something that we will analyze going forward, because we also have to consider how the economies are performing. But definitely bonds are under pressure. Apart from that, there was no much economic data yesterday. We had the IMF, which published its latest forecasts on the growth. Global growth projection has been maintained at 3.2%. India has been maintained at 7%. But the US has been upgraded from 2.6 to 2.8% for 2024. Europe and China have been downgraded. And UK, of course, upgraded. That's a standout because it's upgraded from 0.3 to 1.1%. But IMF is also throwing some caution on the fiscal side, while they're happy about the inflation panning out. We are also heading into in another election even before the US election, that is Japan, general election to be held on October 27th. And several recent opinion polls have shown the possibility of ruling coalition losing majority, and if Ishiba is losing his job, then I think the whole expectation about the Japan monetary policy goes into a lot of uncertainty. How the new leader from the other party would view the Japan's ongoing easy money policy. So that again spin on the market's behavior. So far, other than the bonds, at least equities have been holding up in the global markets. On the European side, markets have been talking about 0.5% cut from ECB in the upcoming meeting, but the ECB President Lagarde's speech yesterday was cautious, and she reiterated a data-dependent approach, irrespective of what the market is expecting. We also have a Canadian Central Bank meeting today. Another hefty 0.5% cut from 4.25 to 3.75 is expected because their inflation fell to 1.6%, much below their target of 2%. So a lot of things happening on the monetary policy and going forward, and also the yields which are guiding the market sentiment. Now, finally, on the rupee, a marginal close at the new highs for the USD INR, continued outflows. Two factors that are likely to keep the rupee on the weaker side is one, dollar index breaking above 104. After failing to break 100, it's been a steady uptrend for the dollar, supported by weak economies elsewhere, and also yields higher in the US, notwithstanding the uncertainty, the elections on November 5. That's one factor, even guiding the EM currencies lower against the dollar, and dollar rupee holding at 84.10 very, very tentatively, even amid large outflows from FIS. I think this is going to come under pressure, and RBI may be letting it fall slightly if outflows continue. The other factor, for India is technical breakout downside on the stock index, seeing break from the head and shoulders pattern on the Nifty index, which indicates a possible fall of another 5% in the index. Thing that we are seeing is that the past 1 to 1.5 years, all dips in the markets have been followed by a good recovery into new highs, but recently the recoveries have not sustained, and we are seeing steady fall, and that could be dampening the sentiment for investors and traders, and possibly the FII flows, or rather the foreign investor selling, could continue, keeping the pressure on the rupee. I feel as dollar index moves towards 105.65, which is the upside of the downward sloping channel of the last several months, I think dollar rupee will be subject to some appreciation towards 84.25 or even 84.50 in the coming days. Thank you.
Thank you, JK, and thanks for answering in such detail about the key narratives which have been keeping the yields higher. And just quickly summarizing that, you mentioned jobs data has not worsened after July, inflation has remained sticky, and markets have mispriced the anticipated rate cuts, and that has been going on for quite some time. And all of this has resulted in a sharp rise in yields in the last few days. And of course, there's a big divergence between US and other economies, which has been quite significant in terms of how the economy has been growing, how the inflation has been growing. When it comes to the IMF forecast, which were released yesterday, they have maintained the global growth projection at 3.2%. US and UK growth has been upgraded, while China and EU growth have been downgraded. Indian growth has been maintained at the previous levels. Japanese general elections will be held, I think, towards the end of October. So that's another significant leadership change that can impact monetary policy. For rupee, it hit a new marginal low. The dollar index has been breaking above 104, and the FII outflows are keeping the rupee weaker. As JK mentioned, the benchmark Indian equity index Nifty 50 has seen significant breakout on the lower side, which will put a bit more a bearish sentiment on the overall trend. That's it from us today. Thank you so much for listening, and tune in tomorrow for the latest in the financial markets.